Hi, this is the Keiser Report. I'm Max Keiser. We're talking about a convergence of catastrophes. This is so good, I actually wrote some notes down here. The ongoing BP oil volcano disaster in the Gulf and our current and ongoing financial collapse. Technologies of deep water drilling advanced much faster than regulation. So Transocean and BP were literally operating in a dark pool without regulation with sophisticated so-called technology. What about financial markets? Ditto. Technology moving faster than regulation. Dark pools and risk spills of toxic credit. Spilling poisonous global atmospheric debt gas. Polluting the entire global economy. Let's bring in Stacy Herbert to fill us in on more details. Stacy.
Max, my first headline. BP admits crucial mistake. Big spat on rig preceded explosion. Top kill underway. Workers getting sick. More videos. So in the fateful hours before the explosion of the Deepwater Horizon, it appears that there was a negative pressure test applied, and BP now says there was a clear warning sign of a very large abnormality in the well, but work proceeded anyway. So this, likening this to the financial collapse, it does remind me of when Chuck Prince, at the famous moment when he said they had to get up and dance while credit was still flowing. And even though everybody said it was going to blow up, you had to keep on dancing. So BP was doing the same thing. They said, we had to keep on moving.
The pressure to commit fraud quickly was intense. And you know why they're out there, out in the boonies drilling, of course, is because we've hit peak oil. All the cheap oil in the world is gone. You've got to go into these further regions, take more risks. Instead of just taking the easy route and developing alternative sources, they go after this peak oil. It's similar, in fact, to 2007, Stacy, when the world hit peak credit, which is a term that I coined back in 2007, 2008, peak credit, leading to massive financial dislocation. Please tell us more.
Well, exactly, and because of this peak oil, President Barack Obama recently, just weeks before the explosion of the Deepwater Horizon, he had opened this very region to further deepwater drilling, and he said that the technology was now so advanced.
And we'll be guided not by political ideology,
it was almost impossible, he said, to have a disaster like this. And the same sort of argument was used in the financial situation. As it got bigger and bigger, the argument was that we're all sophisticated investors in this financial community, and we know what we're doing. And the deeper and deeper the dark pools went, the dark pools of credit, the less control we actually had over it.
Right. These banks kept telling regulators and the public that they were hedged, that they could take these enormous risks. They could chase these little gains, but leveraged by trillions of dollars because they were, quote-unquote, hedged. And just like, as you point out, an excellent analogy here, the BP disaster is caused by taking too much risk for too little gain. The financial crisis in the world, same thing. You're chasing too little gain, and you're taking extraordinary risk, and they're both blowing up at the same time. The economy and the ecology. It's eco twin disasters.
And the other similarity, of course, is that the collusion between these big corporations and the regulators. So in the financial sector, you have the SEC, who is supposed to regulate these banks. And what has emerged post-crisis, of course, is that, in fact, they were letting the banks regulate themselves and checking off the boxes, saying, oh, yeah, we have liquidity. Oh, yes, we have that. Oh, yes, we have all the paperwork. The same thing happened with the BP oil spill. You have the Minerals Management Service, MMS, who were apparently allowing BP to fill out their own form. Have you done the safety checks? Have you done the pressure tests? Have you done all of these things? And yes, they said they did.
Yeah, the SEC and other regulators, they let Wall Street regulate themselves, and they also have this myth going that markets are quote-unquote self-correcting, that, of course, fraud would just be overridden by a moral imperative to seek good price discovery. What a load of lies.
And one more thing on this analogy bit here is that the BP performed these negative pressure tests, and the negative pressure test suggested there was a big disaster waiting to happen. Well, the U.S. Treasury did the same thing with American banks. They did a stress test, and the stress test told them that there was a big disaster waiting to happen. And instead of acting on it, they chose to ignore it.
Peak credit, peak oil. Twin disaster.
Well, now we're moving on to the cleanup. And the analogy continues. Gulf oil spill. White House orders BP to cut use of dispersant by half. Why? Because worries are escalating over the effect of Corexit on marine wildlife. So BP is spraying this toxic dispersant, which is 100% toxic. It's banned in the UK. You're not allowed to use it in the North Sea. But you can liken this to quantitative easing. This is the equivalent of the dispersant trying to sort out, they're just spraying money at these bad toxic debt. And the argument is that quantitative easing, well, we know it's not very effective, and we know it's 100% toxic, but it'll push the bad debts deeper down the column of the bad debts in the world.
Wow, this is genius. So the eco twin disaster, peak credit, peak oil, this Corexit, which is purely 100% toxic, they're dumping into the Gulf to cause even a greater ecological disaster, equivalent to quantitative easing, which is the Fed's toxic remedy to the debt problem by increasing the debt burden by several $1 trillion.
And the similarities don't stop there, Max.
This is genius.
Because, in fact, you know, many are trying to audit the Fed. They want to find out how the over $2 trillion of toxic debts have been put onto their balance sheet. Well, the same thing with the BP oil spill. You have this Corexit being 650,000 gallons of it dumped onto the Gulf. The U.S. government is not allowed to look into what it is. They're not even told what are the ingredients because proprietary rights to it.
So the government can't even examine the toxic material that BP is spewing into the Gulf because it's protected by intellectual property rights?
That's exactly correct.
Okay, so the federal government is taking a back seat way in the back of the bus, the last row in the bus, being driven by BP.
And I might add one more thing on this Corexit. It was at one point, and I'm not sure how much it is now, but it was Nalco, the company that produces Corexit, was owned by Goldman Sachs and Blackstone, who are also involved with the Federal Reserve.
You might as well throw Goldman Sachs in there.
They're involved in everything, aren't they? And then finally, we get to the other similarity between this and the financial disaster. Get down here and take control. We're about to die. This is James Carville, and he's down in the Gulf. And he's demanding that Barack Obama do something.
BP is not the equal of the United States government. And this president needs to tell BP, I'm your daddy. I'm in charge. You're going to do what we say. You're a multinational company that is greedy, and you may be guilty of criminal activity. It's time that we understand BP does not wish this thing well. They have been negligent. They need to whip out their checkbook and start moving in some action.
There is this argument in America right now, you see it across the board, is that you cannot say anything bad about a corporation, anything at all. You can't say anything bad about JP Morgan or Goldman Sachs or UBS or any of the banks involved with the toxic slick of financial products. And just the same here. If you say anything bad about BP, you're considered anti-capitalist.
Like we've been saying on the show, the problem is not that the country's gone socialist or the country's gone fascist. The problem is that the country has gone kleptocracy.
And so we move on to the next headline, and I mentioned the quantitative easing going on to clear up the bad debts. Well, U.S. money supply plunges at 1930s pace as Obama eyes fresh stimulus. Well, it appears that the stock of money in the United States fell from $14.2 trillion to $13.9 trillion in the 3 months to April. That's an annual rate of contraction of 9.6%, numbers not seen since the Great Depression.
Yes, and this is really remarkable, Stacy Herbert, because of what we were just saying. The government, the Fed, and these various other global banks are throwing hundreds of billions and trillions of credit into the market. But still, the gross money supply numbers are contracting because no matter how much money they throw at this problem, these investment banks around the world are hoarding these debts on their off-balance sheet special purpose entity accounts. And every time it looks like the economy might spark back to life, they say, oh, here's another $500 billion in debt. Give us more of your credit. And, of course, when you've got the global economy being held in a stranglehold by kleptocrats and financial terrorists on Wall Street, you don't have money supply turning into velocity of money, which you would need for growth.
But the other thing is, just like looking at this BP oil spill, you can shout all you want. You can say, oh, put more dispersants in or put more booms in and whatever you want to do. The fact is, it's happened. It's a disaster, and there's nothing you can do to stop the fact that all these bad toxic derivatives were built in the first place.
No, the economy is built on toxic technology in the energy business and toxic financial technology in the finance business. And, of course, those two are the twin pillars that support not only the eco twin disaster, but the warmongering in the Pentagon budget, which leads to, mighty problems of blowback.
Well, that is another good point, is that Ben Bernanke has always argued that all he had to do was drop money from helicopters and that he would sort out he would prevent a next Great Depression. That hasn't worked, obviously, clearly from these numbers. But he also has mentioned in the past, and he said this on the record, is that World War II got us out of the Great Depression. And you have to wonder what's going on with North Korea, all these aircraft carriers being sent to the Persian Gulf. Is this their solution, ultimately, to get us out?
That's right. Ben Bernanke's helicopter has effectively flown into a debt black hole.
That's correct.
All right, Stacy Herbert, thanks again for being on the Keiser Report.
Thank you, Max.
Don't go away. We'll be right back.
Every month, we give you the future. We help you understand how we'll get there and what tomorrow will bring. The best in science and technology from across Russia and around the world. Join us for Technology Update on RT.
Welcome back to the Keiser Report. Let's turn to Heidi Moore. Heidi Moore is a financial journalist for thebigmoney.com. Before that, she was at the Wall Street Journal. She is also a prolific tweeter that you should be following on Twitter, where you can see her twit slap the likes of a very shrill Felix Salmon, not to mention frequent Keiser Report guest and man about town, Joe Wiesenthal. Heidi Moore, welcome to the Keiser Report.
A pleasure to be here. That's quite a build-up.
All righty. Now, before we get into kind of the story of the day, I wanted to revisit something you wrote not too long ago called Glitchcraft, talking about the May 6th 1,000-point drop. Tell us a little bit more about what you found about this.
Yeah, what I found was actually sort of nihilistic. What we found is that people still don't know anything about what caused the flash crash of May 6th that lost trillions of dollars in market value for a lot of company, certainly hundreds of billions. And I think it's called into question a whole lot of issues about market structure and the stock market that really a lot of people let lay fallow and stopped thinking about after, say, 2002. And now we have this giant financial reform bill that's going through Congress, and it doesn't address market structure at all. And so now we have a lot of band-aids from the SEC and from various stock exchanges and regulators trying to fix what we forgot to do over the past 8 years.
Right. So here you have this huge crash on May 6th, the flash crash, as it's called. There's still a mystery as to what surrounded it. And amazingly, you would think the first thing, you know, the order of the doctor is, the first thing is cause no additional harm. But here we have, and this is the next story I wanted to get into, the CFTC, Commodity Futures Trading Commission, they're going ahead or reviewing or looking at proposals to introduce box office futures contracts, which is a recipe for disaster in ways we've covered on this show, and you've recently written about it in a piece called Lights, Camera, Derivative Trading. Talk to us a little bit about that, and then we can talk about the information that just came out of Disney this past couple of days.
Absolutely. Well, right now there's a proposal being considered to approve some contracts that would trade box office futures. And of course, that's a product you know very well because you created its virtual predecessor back in 1996. And so these contracts would essentially allow people to bet $5,000 or so, that's how much they cost, on box office receipts and opening weekends. And this sounds like a fairly decent idea. Wall Street creates financial innovations all the time. We have derivatives and futures on everything from pork bellies to wheat to weather predictions. And so why should this be different is often the question. And the answer is that this actually has a greater chance for danger because box office futures are not based on physical assets like, for instance, natural gas, nor are they based on sort of unchangeable facts that you need to hedge against, like the weather. Instead, box office receipts are really a function of Wall Street marketing budgets, which are, as we know it, hype. And so if you have a derivative that is based on hype and that is built only for speculation, then it's really going to create a dangerous speculative casino aspect to what is otherwise a fairly respectable derivatives market.
Right. When you take away the physical assets, you take away the lumber in a lumber futures contract or the pork bellies in a pork belly futures contract, what you're left with is only insider trading. This is a futures contract based on insider trading. Like my old partner at the Hollywood Stock Exchange used to say, Michael Burns, who's now vice chairman of Lionsgate Films, he used to say insider trading is legal on the Hollywood Stock Exchange. And, of course, Cantor Fitzgerald has picked up on this mantra, and they are putting into the public a contract which is extremely dangerous given the fact that we've had the Commodity Futures Modernization Act, repeal of Glass-Steagall, and all manner of disintegration of the firewalls between banks, brokers, speculators, hedge funds, and now Hollywood. And it seems to me this is just going to lead to the gutting of yet another American industry. Your thoughts, Heidi Moore?
I think that's what a lot of people predict. I mean, it's certainly what you predict, but I also talk to a lot of other people who believe the same, which is that really you can't build a base of speculation and allow that into the market and expect it to remain contained. Eventually, leverage, which is debt, will come into that market and it will increase its size. And the better it is, the more people will get into it. And so you can't really start up kind of a dangerous-looking market and say, well, it's okay because it'll never really get that big, because you can't think that realistically. If it works, or if it's popular, or if people make money, it will get big, and it will keep on getting bigger, and asset prices will keep getting bid up, and people really have a chance to lose money because the size of these contracts, $5,000, shows that they're really intended for retail investors. These aren't big institutional contracts that cost millions of dollars or, even tens of thousands of dollars. It's only $5,000, which almost anyone can put money into, and that's why they really need to be looked at very, very closely.
Right. It adds to the systemic risk because, of course, you've got roughly $10 billion or so a year in box office, which will be used as the financial backdrop for these futures contracts. And, of course, that will be leveraged up to probably a $200 or $300 billion industry when you add in all of the various derivative products that will be tied to these products. And, of course, that's highly destabilizing, especially when celebrity, what we're talking about here, is disseminated globally instantaneously. Every media outlet in the world will be trading on rumors and hoping to profit and manipulate this market based on this rumor mill that is part of Los Angeles, which is very tightly controlled by the industry monopoly players. Right on cue, we hear that the SEC has charged Disney employee and a boyfriend in a brazen insider trading scam. This is exactly the problem. Talk to us a little bit more about this.
Yeah, that was, as one of my former colleagues put it, a true Mickey Mouse operation. Essentially, an executive assistant in one of the Disney executives' offices, corporate communications, I believe, or communications, took or promised hedge fund managers the chance to take a look at earnings before they came out. And it was done in a very amateurish way. They actually wrote to 20 hedge fund managers and said, hey, you want to inside trade with us? And, of course, no one took them up on it, except that a federal representative caught on to it and caught them. But it's a very good example of how Hollywood is not really used to rules on information the way that Wall Street is. People might call Wall Street kind of this chaotic boys club, but it's really a gentleman's club in that people know when information should be traded on and when it shouldn't. They might violate it, but they know. And in Hollywood, they don't know that because information is just much more casual, and it's how deals are made. And they're not used to any kind of regulator coming in and saying, you can't say this to this person and you can't say that to that person. They think all information is theirs to share.
Well, I was talking, in fact, to an executive at Disney a few years ago when I was running Hollywood Stock Exchange, and they were trying to encourage me to move prices for their projects on the virtual exchange, and I was trying to explain to them that that would be market manipulation, but they couldn't see the difference between that and what they called marketing. So, again, in Hollywood, market manipulation, marketing, the same thing. Let's move on to a couple of other observations and things you've been writing about. You mentioned at the top of the story financial reform. Where are we with financial reform in the U.S. now, Heidi Moore?
Sure. Well, right now we have two bills that need to be reconciled. We have the Senate's version and we have the House of Representatives version. And so between now and about July 4th, they're going to be engaged in reconciliation, which is basically horse trading about what the most important parts of the different bills are. And then they're going to unify it into a single financial reform bill. And it is immense. It's, the Senate bill alone is 1,600 pages. And there's no reason to believe that reconciliation will shorten that significantly. So people will really be thinking about the consequences of this for months, if not years to come, because very few people have had the chance to really analyze what the implications of these two bills are, much less what they are when they come together into one big omnibus.
But isn't the history of this, federal regulators come in with some new laws, Wall Street comes up with some financial innovations to go around the laws. Isn't that what we're going to see again?
Yeah, I mean, that's what Wall Street does. It comes up with financial innovations, and sometimes it doesn't have such a great record. I think the problem is that innovations themselves are not bad, but what happens is they become open to speculation, because the whole point of Wall Street is to find a place where no one else is making money and try to make money there. And so you often see tiny little markets blow up into economy-destroying behemoths. I mean, that's what you saw with the subprime market and the mortgage crash. And so there will be financial innovation, but the question is now, can we regulate to such an extent that we can have innovation, but at the same time, we also don't have the danger of bringing down the economy with it, where we have curbs on leverage, where we pay closer attention to fraud as it happens, and where we have better reporting. If we can do that with financial regulation, then we're part of the way there. But there's no reason we should have to kill innovation, because a lot of these new products actually do help companies. They help hedge against problems with currencies or problems with, fuel costs or things like that, which they really do need to keep going. The important thing is we need to control the effect of it.
What do you say to these bankers, though, who seem to espouse radical financial, unfettered, unregulated speculation without any thought about the wider consequences to the economy as a whole? They seem to think that they're somehow adding to the benefit of society by destroying society. And I see this tension in the blogosphere all the time between folks who are adamant in defending what I call the financial terrorists and the market fundamentalists, and folks who are just reasonably saying, look, you've got to curb leverage, you've got to curb speculation. How do we bring some reason back into the debate, Heidi Moore?
Well, I think that right now we're really up against a wall, because we have this issue where no one side is listening to the other. Washington has retreated into its bunkers and Wall Street into its barracks, and they're not talking to each other anymore. And so both of them have good points. Washington has the point that we've seen too much leverage, too much speculation, and there's a lot more money at stake than that which Wall Street claims it has. Wall Street tries to say we are the princes of finance and we don't have to answer to the populace because we're dealing at such a high level. But that's not in fact true. The money that they deal with comes from the populace for the most part, and they do have to answer to us. And the bankers, for their side, say, we're trying to keep money moving through the markets. And there are good reasons for that. Like I said, companies need to raise money. They need to finance their operations. All of that Wall Street helps with. The issue is, how do we do that in such a way that we don't kind of let the edge of it get too big? But unfortunately, it's really hard to get that message across, because Wall Street has just been so beaten down for the past 2 years. Like, they've really been demonized, and they've decided to stop listening. They've kind of locked themselves away inside their heads and said, we're not hearing anything productive, we're only being attacked. And, so it will be, I think, quite some time before we actually reach a rational resolution of these issues where both sides are psychologically prepared to understand what they did wrong and to start dealing. Because Washington participated as well in the subprime crisis, and they haven't acknowledged that. So it's on both sides, the denial. The program trading and the high-frequency trading it continues unabated. The siphoning off of assets and cash by Wall Street banks continues, and the system becomes more destable every single day going forward, until ultimately the only thing to resolve this thing is going to be a huge, gargantuan depression-like crash. Okay, Heidi Moore, that's going to do it. Thanks so much for being on the Keiser Report. Thank you. It was good to be here.
Okay, and that's going to do it for this edition of the Keiser Report. If you want to send me an email, please do so at keiserreport@rttv.ru. I want to thank my guests, Stacy Herbert and Heidi Moore. And until next time, this is Max Keiser saying bye, y'all.